G'day guys, Adam Grokey again from Johnson Grokey and Nick Rustling from Johnson Grokey as well. This is video number 2, that's gone quick. Video number 2 talking about what makes a good property investor versus a bad property investor.
I think it's really key to understand that as well, and I think it's more so, it's not about us identifying that in you, it's about you understanding yourself, you know, what sort of traits you're looking for, you know, what sort of things you can do. And now look, anyone out there can be an investor. It's just you've got to bring this attitude to it, I suppose. You don't have to change who you are, you just got to bring this attitude to the investment.
Yep, absolutely. And look, one of the things that investors struggle with at the start is they struggle with that first step. Right? And I think the reason why they struggle with that first step actually comes down to our key points of why good investors actually make the right decision.
Exactly.
And the first one with that is emotion. So people are scared to take that first step because it's a lot of debt to take on for an investment property.
It is.
You know, you're talking 300, 400, 500,000. When the debt they've taken on before that might have only been a $20,000 car loan. Like, that's a significant difference. Also the unknowns. You know, you've got these scary tenancy stories and you've got everything else. So I think as an investor, what you need to do is you need to make sure you can check your emotion at the door in any decision. So that's your fear. Fear's good if you can recognise it and then park it. Same with optimism, recognise it and park it. Because what you need to do is when you're investing, you've got to take emotion out of it, and that's one of the key things.
It really is, and like, you know, you touched on it there, that emotion works both ways, and that leads into, you know, ego. Ego in property investing, we see so many times that it can get in the way of a smart decision. So you really need to be able to make sure you've got all that in check, and as you say, you can leave it at the door.
I've got 4 investment properties. I'm really cool.
Exactly.
I'm really wealthy. And it's quite interesting because a lot of people actually, especially Australians, go, "Oh, how many properties do you own? Are you wealthy?" And it's like, that's actually irrelevant because it's your net wealth. It's how much equity you've got in the properties minus whatever that debt is. And remember that that's actually still not your net wealth position because you've got to take in selling costs if you want to access that equity. And then you've got to pay capital gains. So a lot of people talk about, I've made $100,000 from that property, but when you actually look at the numbers, it's not 100,000.
Exactly right. Yeah, add it all up, you take into account all the bits and pieces that came through along the way. Just because you paid $200 for it and it's now worth $4 doesn't mean there's a $200,000 property in there at all. So, you know, there's a lot more that goes into it, I suppose. And I think understanding those is a real key.
Definitely. So with the emotion, I mean, as much as possible, check your emotion at the door. Make sure that all your decisions are actually objective and not subjective. So try and do as much research. There is so much information out there at the moment with RP Data and CoreLogic, and CBA and ANZ have apps, free apps, download them where you can get property reports and you can get information. We do property reports, so we can give you that information as well. Just get all the information so you're making an objective decision. One tip that I really loved in terms of if you're going to choose suburbs, that came from Peter Kolizos, the property professor, very well known around Australia. He said, find the suburbs that have the highest median price and buy next door. Because Australians at some stage won't be able to buy in that expensive suburb and they'll just buy the next closest to that desirable area. So where possible, check your emotion and make objective decisions. The second one is planning.
And planning's, I mean, it's key in everything, absolutely key in everything we do. And I think that understanding firstly what it is you're doing, a lot of people go into it with no plan, as you say. So it's just, I want to be a property investor. Okay, cool. Which way do you want to do it? You know,
and why?
What's your reasoning behind that? I mean, we touched on in our first video about the property profiles that we do here, and that whole profile, the sole reason of that almost is to find out that why it is that you're really wanting to do this. I mean, I know you used the example in a chat we had before that people go to the grocery store and they write out a list and they plan to go to the grocery store, but yet they come into a property investment and we see people that have just got no plan, no anything in place. So it's really key to understand firstly why you're going into it, what it is you're looking for, and then really develop that plan. You know, don't be afraid to pay for advice, to do things like that, because you really should be getting those first, second, third opinions. I mean, potentially. And you know, for 99% of Australians, property investment will be the largest investment you make in your life. So it's a big liability to hold. So you want it to be smart. So we can fall in love with the Australian dream a bit of owning a home, but doing it the right way and planning for it the right way. You know, there's no time limit on these sort of things, so don't rush it. If it's not right, if it's not there, don't do it. So,
well, I see that all the time. The biggest financial investment that people will make, and they do the least planning that they've ever done on any decision that they've done, any decision they've made. So make sure you plan. Have a really good plan. Ask yourself, why am I buying this property? Is it just because my parents did it? Is it because my mate did it and they said to do it? Understand why for you it's important to buy an investment property, and then understand what you want to get from it. I think that's really important.
And that goes further, sorry, I'll just touch on that again, that goes further than just what you want from it now. That's what you want from it in 5, 10, 15 years. You know, have I got a plan in place here? Have I got a target market that I'm looking to do something with this property for? You know, have all those sort of things in line. It's not, you know, you can be the house out there that you just buy and this is my forever home. There's nothing wrong with that. There's no problems with that. But understanding that first is sort of the real key to it.
You only make money from property when you sell. Who's going to be the buyer that's going to pay the maximum price for it?
Exactly.
Yeah. The other one's be patient. Like you really, and we mentioned in the first video, you can't be out there trying to pick the market, right? Trying to pick the market is so hard, and that's because the market is driven by multiple variable factors that you can't control. No one really can control.
Factors outside of Australia's control. You
Absolutely.
know, it's a world market as a whole, the property market.
Yeah.
So, you know, a lot of things that are completely out of our control, you know, you can't focus on those.
Yeah. So you just got to be patient. Know that if in your plan, this is a 10-year plan, and the property market's flat or the property market dips a little bit, see it out. We've got an image that we'll put up as part of this video as well, which shows the property cycle. The property always goes in a cycle. What we don't know is how long it is between each cycle. So if you're patient enough, you should see a cycle of a boom. There's going to be a bust at some stage, or it'll go flat and then it'll go back through building and a boom again. So just make sure you're patient. Don't get too patient, because property is a long-term investment if you're going to do a buy and hold strategy. There are quicker ways to do developments, turn them over in 12, 24 months, much higher risk.
Creating value in other ways other than capital growth, really.
Absolutely.
So creating value by actually putting it into it. But, you know, everyone out there will tell you that you buy it when the market's at the bottom and you sell when it's at the top. Well, it's just not that simple. I mean, the bottom to the top of the market could be 20 years sometimes.
Exactly
You know,
right.
there's no time frame on it. So if it was that simple, we'd all be making a lot more money from property.
Absolutely. And look, the other thing is avoid barbecue advice. I mean, it's one of the things that I hear all the time. You're at a barbie, you're talking to your mates, I've got 3 properties, I've invested in this, I've done so well out of this one. They're not going to tell you if anything goes wrong. They're not going to tell you how much money they've really made. And also, they may have made multiple mistakes over their investment time frame that have been covered up by capital growth, because capital growth happened just because it did. Right? In Sydney, for example, or in Melbourne, or even here in Adelaide, there's been suburbs that have just grown.
You couldn't lose money in that Sydney market. You
No,
could have
that's
been
right.
the worst investor ever, and you still would have made money.
And you think you're so good because you've made money.
Exactly.
But if in a flat market, you actually would have lost significant amounts of money. So the other thing is that whatever other people do is completely irrelevant to what your why and your plan and your objectives are, and what you want to get out of it. So just because they've got 3 properties, completely irrelevant. Are they chasing growth? Are they chasing yield? Are they looking for development opportunities? Are they looking for rezoning? That's completely irrelevant to what yours are. So you've got to forget everyone else, what everyone else is saying. Listen to an expert that's going to build it around what you want as an individual, and that's the way you're going to build your plan, take emotion out of it.
And the time that you're doing it as well. So, you know, let's use you and I, for example. We're having a chat at a barbecue. You own 3 investment properties.
I wouldn't talk to you at a barbecue with that mo, by the way.
Always bringing everything back to the road. It's got 2 days left. Leave it alone. But if we were chatting at a barbecue and you're telling me about your property investment over the last 10 years, right? And you say, I've got 3 properties and this and that and the other, and I'm looking at getting into the market now. Your advice is almost irrelevant, because you did it in the last 10 years where you're at completely different times in the market. You know, your why might be completely different to my why. So look, by all means, doesn't mean don't talk about it. Have those conversations, but don't hang your hat on things that you hear.
That's right.
You know, really get the advice about the current times and dinner.
Pick up on everything, but just take it all with a grain of salt. Thanks for your time, guys. Really appreciate it. There'll be a link to our blog. Our blog's got much more information, much deeper information in all of this. We want to turn you guys into good property investors. If you are out there in the market, have a chat with us. We're not here to sell you anything. We just want to help you guys make the right decisions so you can actually succeed in the future. Thank you very much, and have a good day.
Cheers.